Now the next topic is bank reconciliation statement. Before knowing about the bank reconciliation statement, we have already discussed in detail about the cash book. In cash book, we prepare the single column cash book and double column cash book, cash and bank. When I am talking about a bank reconciliation statement, our focus will be only in the bank column, only on the bank column of the cash book. Okay? The company open the current account. Company open the current account in the bank, and they do the transaction with the bank. They deposit the money, withdraw the money from the bank. So whenever the company open the current account in the bank, and all transaction done by the company through that current account. Yes. So bank from prepare the customer's ledger, means company's ledger in their books of account, and that account is prepared by the bank staff, bank accountant of the bank. Company prepare the cash book. In cash book, bank column, when they deposit the money, they write in the debit side of the cash book, and when they withdraw the money from the bank, they write the credit side of the cash book. Is it clear? When we deposit the money, we record in the debit side, means receipt side, and when we withdraw the money from the bank, then we write or do the entry in the credit side of the cash book in the bank column, and then we'll find out the balancing figure of the bank. Bank on other hand, bank in their book, they operate the customer's ledger, and when the customer deposit the money, they do the credit in their ledger. They do the credit, and when they withdraw the money, they do the debit in the customer's ledger. So they do the opposite entry, reverse entry. What we do in the debit side in the cash book, the bank do the same entry in the credit side of customer's ledger. And what we do in the credit side in the cash book, the bank do the debit side in the customer's ledger. So come to the bank reconciliation statement. Bank reconciliation statement is prepared with a view to know the difference, or to view to find out the difference responsible for the difference in between bank balance as per cash book and bank balance as per passbook. And thereafter, knowing the difference, thereafter we reconcile it. So bank reconciliation statement is prepared with a view to know, or with a view to find out the causes responsible for the difference in between the bank balance as per cash book and bank balance as per passbook. And after knowing the causes of difference, the next step in the bank reconciliation statement is to reconcile it. So bank reconciliation statement. So bank reconciliation statement is a statement prepared. Bank reconciliation statement is prepared mainly to reconcile the difference between the bank balance shown by the cash book and bank balance shown by the passbook. Okay. Now see how we do the entry in the cash book and passbook. Cash book is operated by our accountant, mean accountant of the business accountant of the company. Cash book is operated by us. In the debit side, we write the receipts, means we write the deposits. When we deposit the money, we write in the debit side. I am talking only about the bank column. One single column, I am talking about bank column. In bank reconciliation statement, my focus is on bank only. Our focus is on bank. So when we deposit the money, we write in the debit side to cash account. When we deposit the cash, what we write? to cash account. To cash account. When we deposit the money, we write to cash account. Okay, this side. When we withdraw the money from the bank, we write this side by cash account. Or when we have given the check to somebody else, suppose we have given the check to Ramesh, then we write by Ramesh account, and then we find out the balance, and thereafter we find out the balance of cash book. Is it clear? This way we operate the cash book. Now this is operated by our accountant, means accountant of the business. Now when we deposit the money and withdraw the money from the bank in the current account, so that entry is also done by the bank in the customer's ledger. Which ledger they are called? This ledger is called customer's ledger. The copy of that ledger is called passbook. Passbook. Okay. So when we deposit the money, we write in the credit. This is deposit credit, withdrawal debit, and balance. Thereafter we will find out the balance amount, and that balance may be the debit balance or credit balance. For instance, when we deposit the money, then we will write by cash account. Suppose we deposit the money 80,000. So we will write in the deposit column. Deposit, it's a credit, and the same entry is done by the accountant of the business accountant. They do it in the debit side, and bank do the entry in the credit side. Only difference is this: whatever the entry we do in the debit side in the cash book in the bank column, same entry is done by the bank in the customer's ledger in the opposite side. So credit side, whatever the entry we do in the credit side of the cash book, the same entry is done by the bank in the passbook in customer's ledger, which is recorded in the credit side in the debit side, that is the withdrawal side. So when we deposit the money, suppose 80,000 is deposited, so we'll write by cash because we are going to write in the credit side. And when we withdraw the money, suppose we are going to withdraw the money to cash, withdraw the money, suppose we have withdrawn 45,000 from the bank, then our balance is 80 minus 45, balance is 35. Balance amount is how much? 80,000 credit minus debit. So net balance 35,000 indicate your credit balance. Credit exceed the debit. Suppose again we have given the check to Ramesh, and we have issued a check to Ramesh 40,000. So withdrawal side we will write it debit column, and the balance will be previous balance was 35. Now this much is withdrawn. So next balance is 35 minus 40. Next balance is 5,000, and this balance is debit balance because credit is 35 and debit is 40. So 40 debit balance exceed the credit balance. So difference indicate 5,000, and this balance is your debit balance. So whatever the entry we record in the cash book debit side, the same entry is recorded by the bank in the passbook in the customer ledger in which side? Credit side. Credit. Deposit is credit, and here deposit is debit. And when we do the payments, we write in the credit side in the cash book, same is written by the, or same is recorded by the bank in the passbook in customer ledger in the withdrawal column, and it is debit. This column, this is called debit balance. Debit. Withdrawal is debit, deposit is credit, and here the deposit is debit and withdrawal is credit, just opposite. Cash book, in cash book, debit, deposit, and credit, withdrawal. In passbook, just opposite. In passbook, debit, withdrawal, when the money is withdrawal, and credit is deposit, just opposite side. So the bank balance as per cash book and bank balance as per passbook must be matched. Only difference will be bank balance as per cash book credit if it is 15,000, then bank balance as per passbook will be 15,000 debit. Is it clear? If the bank balance as per cash book is 15,000 debit, then here the bank balance as per passbook will be 15,000 credit. Only difference is this. So whatever the entry we record in the debit side of the cash book in the bank column by our accountant, same entry is done by the, or same is recorded by the bank in the customer's ledger in the credit side. And whatever the entry we recorded in the credit side in the cash book, the same is recorded by the bank in the debit side of the customer's ledger. So the bank balance as per cash book and bank balance as per passbook must be same, but due to some reason the balance of bank and balance of bank balance as per cash book and bank balance as per passbook may differ due to some reason, and for that we prepare bank reconciliation statement, maybe fortnightly, monthly, quarterly or half yearly. So bank reconciliation statement is a statement which is prepared with a view to find out the causes responsible for the difference in between the balance as per cash book, bank balance as per cash book and bank balance as per passbook, and thereafter reconcile it, and thereafter reconcile the difference. Is it clear? Now we have to know the causes of difference. What are the causes due to which the bank balance as per cash book and bank balance as per passbook may differ? What are those reasons? So reason may be because of time gap. The transaction recorded in cash book and passbook may be recorded but record in different time interval. Because of time gap, the balance of cash book and balance of passbook not matched with each other. Another reason may be due to some errors. Maybe the errors committed by our accountant in the cash book, or errors may be committed by the bank in the customer's ledger. So if the error is committed by our accountant or accountant of the bank, then the bank balance of cash book and bank balance as per passbook may differ. So causes of difference may be, causes of difference, number A, difference caused by time gap. Time gap means the transaction is recorded in cash book in different date and in passbook in different date in recording the transactions. Second reason is difference caused by error committed by our accountant in the cash book or the accountant of the bank in the passbook, means in the customer's ledger in recording the transactions, So causes of difference, number one, difference caused by time gap in recording the transaction, time gap, and second is difference caused by errors committed in recording transaction. So we'll see the first one, difference caused by time gap in recording the transaction. What are the errors comes under this? Number A. So the first one is difference in cash book, bank balance as per cash book and passbook is due to time gap. Point number A, time gap. This difference may be check is issued to the supplier, but that supplier or party is not presented that check into the bank. Okay, check is issued by the business to the supplier or the third party, but that third party or supplier is not presented that check for payments. So the cash book balance is reduced but passbook balance is not reduced. Next, maybe the check is deposited into bank, but that check is not collected by the bank and not credited by the bank. Maybe the reason, maybe the check is deposited but dishonored by the bank, So check is deposited into bank, but that check is dishonored by the bank. When the check is deposited, the bank balance as per passbook has increased. But when it is dishonored by the bank, so passbook balance is not increased. That may be the reason for difference. Interest allowed by the bank but not informed to the customer. Not informed to the business. So when the interest is allowed, passbook balance has increased, but it is not informed to the customers, then customer is not done this entry in the debit side of the cash book. Similarly, interest charged by the bank, but not informed to the customers. So when the interest is charged, the passbook balance will reduce. When the interest is charged by the bank, whatever the reasons may be, on overdraft or any loan is taken by the bank, and any loan is taken by the customer and the interest is charged, the passbook balance will reduce, but this information is not given by the bank to the customers. That's why the customer is not recorded this transaction in the cash book credit side. So passbook balance has reduced, but cash book balance is not reduced. Okay. Sometimes bank collect the dividend or interest or rent on behalf of the customers as per the instruction given by the customer. And when as such collection is done by the bank, whether it's a dividend, whether it's a interest, whether it's a rent, when the bank is collected, after collection he has not informed to the customers. So passbook balance will increase, or passbook balance has increased because of this reason, and it is not information is not given to the customer. That's why customer is not entered this transaction in the cash book, in the debit side. So this is also the reason for the difference between the cash book and passbook balance. Similarly, bank may do the payment as per the instruction given by the customer to third parties. Sometimes customer give the instruction to the bank that you do the payment of my electricity bill, you do the payment of my insurance premium, you do the payment of my rent or taxes. So if such instruction is given by the customer to bank, and bank has done such payment, but after the payment bank is not informed to the customer that these are the payment, the bank has done it. So due to the time gap, there will be a difference between the balance, there will be difference in balance between cash book and passbook. Is it clear? So there are so many reasons. So reason number one, difference caused by time gap. Time gap is the one of the reasons. Number A, time gap in recording the transaction. Number one is check issued but not yet presented for payment in bank. Check is issued but not yet presented for payment in the bank, the person to whom you have issued the check. So cash book balance is reduced but passbook balance is not reduced. Second one is check paid into bank. Paid into bank means deposit into bank. Check is deposited into bank for collection but not yet credited by the bank. Bank is not credited that amount in the passbook. It means bank is not collected that amount of the check. That's why it is not credited in the passbook. So this may be the reason for the difference. Check paid into bank for collection but dishonored by the bank. Interest allowed by the bank but not informed to the customer. So when interest is allowed, passbook balance has increased but cash book balance is not increased because the intimation is not given by the bank to customer. Next is interest charged by the bank, but the intimation of this interest charged by the bank is not given to the customer. In that situation, the passbook balance has decreased but cash book balance is not decreased. So this is the reason for the difference because of time gap. Bank charges and commission charged by the bank. Bank charges and commission charged by the bank, but intimation of this commission and bank charges is not given by the bank to their customer. So passbook balance has decreased, but cash book balance is not decreased because this transaction is not recorded in the cash book credit side. It is not recorded in the credit side of cash book because intimation is not given to the customer. Direct deposit by customer into bank. Sometimes what it happened that the customer may deposit directly into the business bank account. So if the customer directly deposits the amount in the business bank account, business current account, and the intimation of that deposit is not given to the business, then passbook balance has increased but cash book balance is not increased because the transaction is not recorded by the business in their cash book. Similarly, interest and dividend collected by the bank on behalf of the customers as per instruction, as per standing order. So if the interest and dividend collected by the bank as per standing instruction, as per the instruction, as per the order, but the intimation or the information regarding that collection is not given by the bank to the customer on time. So the passbook balance has increased but cash book balance is not increased because it is not recorded in the debit side of cash book. Next is direct payment by the bank on behalf of the customers as per the instruction. Sometimes the bank may do the payment directly to the as per the customer's instruction. Maybe the insurance premium, maybe the electricity bill, maybe the rent, whatever it may be, maybe the tax. So if such instruction is given by the customer to bank to do the payment, and bank has done this type of payment, but the information regarding this payment is not given by the bank to the customer on time, so there will be a difference between the bank balance as per cash book and bank balance as per passbook. Is it clear? So direct payment made by the bank on behalf of the customer. Bank serves as an agent. You know the banking function, bank also serves as an agent of the customers. So on the basis of that, these two functions, interest and dividend or rent collected by the bank on behalf of the customer as per the standing order or instruction, but the information if it is not given by the bank to the customer regarding that collection, then on that circumstances the passbook balance has increased but cash book balance is not increased because it is not recorded in the debit side of the cash book. Similarly, direct payment made by the bank as per the instruction, as per the standing order, as per the request, the bank has do the payment, did some payment, but the information regarding that payment is not given by the bank to the customers, then passbook balance has decreased but cash book balance is not decreased because it is not recorded in the credit side of cash book. Is it clear? So these are the certain points. Because of that, the reason is what? In all this point, reason is what? Time gap. Time gap in recording the transactions. In recording the transaction is recorded, but in one book, in cash book it is recorded on certain date and in passbook it is recorded on another day, or in the passbook it is not yet recorded. Is it clear? So difference caused due to time gap in recording the transactions. Second reason for the difference is difference caused by, reason is what? Caused by errors committed in recording, the transactions. Previous reason was time gap, and this reason is errors committed. Here the error is committed in recording the transactions. Now the errors is committed by our accountant, by the business, or the error is committed by bank. So error is committed in cash book by our accountant, or errors is committed in passbook by the bank. So you have to see. So first one is errors committed by the firm. Where? In the cash book. Error committed by the firm in the cash book by the firm's accountant. So what are those errors? Check is issued to a creditor. Check is issued to a creditor, but omitted, but omitted to record in cash book. Forget to record that transaction in the credit side of the cash book in the bank column. Check is issued to a creditor but omitted means forget to record the transaction in the credit side of the cash book. Second is check is deposited into bank but omitted to record in the debit side of the cash book. Is it clear? Errors in totaling in cash book. There is a totaling error in cash book. Next is there is errors in posting in cash book. Instead of posting in the debit side, the amount is posted in the credit side. Instead of posting in the bank column, we have posted in the cash column. Instead of posting in the cash column, we have posted in the bank column. They are the two columns. Error in balancing the bank column of cash book. Sometimes we do the error in balancing by balance CD. Wrongly we have find out the wrong balance. So error in balancing in cash book. So these are the 5 types of errors which is committed by the accountant of the firm in the cash book. These errors are committed by whom? By the accountant of the firm who is operating the cash book in the cash book. So check issued to a creditor but entry is not recorded or forget to record in the cash book. Which side? Credit side. Check deposited but omitted to record in the debit side of cash book. Errors in totaling errors. Sometimes we do the totaling may be overcasting or totaling may be undercasting. There is a errors in totaling in cash book. The error in posting. Instead of posting in the credit side of the cash book, we have wrongly posted in the debit side. Instead of posting in the cash column, we have posted in the bank column. Instead of posting in the bank column, we have posted in the cash column. So these are the errors committed by the accountant of the bank, accountant of the business accountant in the cash book. Errors in balancing the bank column of the cash book. Now next is error committed by the bank. Error committed by the bank where? In the customer's ledger. By the accountant of the bank, by the cashier of the bank who is operating the customer's ledger, that cashier or that accountant has committed errors in the customer's ledger, that is in the passbook. So which type of error? Record wrong entry. Record wrong entry. Instead of suppose 7,520, the bank has recorded 7,250. Wrong entry is recorded by the bank in the passbook in the customer's ledger and committed any other sort of errors committed by the bank cashier or bank accountants in the passbook means in the customer ledger. So the error committed by the firm, accountant of the firm, or error committed by the accountant of the bank. So we have to see where the error is committed. Who has committed the errors? Error is committed by our accountant, means firm's accountant in the cash book, or error is committed in the passbook in customer ledger by the accountant of the bank. So we have to find out this thing. Okay. Now next is in the bank reconciliation statement, that is the need. Why do we prepare or why we are preparing the bank reconciliation statement? Why do we prepare bank reconciliation statement? It means I am talking about the need and importance of bank reconciliation statement. So need and importance are, number one need is, if we are preparing or if we prepare the bank reconciliation statement periodically, then easy to detect error, locate the errors or omission that have been committed either by the bank or by the customer, and by the customer means in the cash book. So if we are or we will prepare the bank reconciliation statement periodically, maybe fortnightly, quarterly, half yearly, then definitely this will help to locate the errors or omission committed by the bank or by the customer. Okay. Second is, it's sure of the correctness of the bank balance shown by the cash book. Okay. It shows the correctness of the, but when we prepare the bank reconciliation statement, the customer becomes sure of the correctness of the bank balance shown by the cash book. So you will be sure of the correctness that yes, the bank balance shown by the cash book is correct. Bank balance as shown by the cash book is correct or not correct. If you are preparing BRS, then it shows the correctness of the bank balance shown by the cash book. Next is facilitate in the preparation of revised cash book. It helps to prepare the revised cash book. If there are any errors is committed in the cash book, then it helps to prepare the revised cash book. Next is preparation of revised cash book. Next is reduce the chance of embezzlement or fraud. It reduces when we prepare the BRS timely and a suitable time interval, half yearly, quarterly, fortnightly, monthly, then definitely this will reduce the chance of embezzlement or fraud. Okay, embezzlement or fraud by the staff of the bank as well as the staff of the business. Next is, this point is that reduce the chance of embezzlement or fraud committed by the staff of the bank and the staff of the business both. Helps in revealing the unnecessary delay in the collection of check. Check must be collected, collection of the check must be done on time. So if you are preparing the bank reconciliation statement, then we can see that the check which was deposited on this date, when that check is collected by the bank. So it reveals the unnecessary delay in the collection of check. If any check is collected late, maybe 10 days late or 5 days late, then we can talk to the bank manager. We will talk to the bank manager, why such late, why such late. So this will reveal that this check is collected on time and this check is not collected on time. If the check is not collected on time, then we have to report to the bank manager and we have to know the reason why the check is collected in a late hour. Helps in keeping a track of checks which has been sent to bank for collection. It helps to keep a track of all the checks which are sent to bank for collections, that this check is sent on this date and collected on this date, this check is sent on this date, collected on this date. So it helps in keeping a track of checks which have been sent to bank for collection. So these are the need and importance of bank reconciliation statement. Okay.